Hey there, how's it going? Robert Mendieta here from Apex Real Estate Services. Most investors look at an industrial deal and immediately jump to the cap rate, but that's actually one of the most dangerous things that you can do when analyzing properties. Today I'm breaking down a real industrial deal analysis so that you can see exactly how smart investors elevate these properties and, more importantly, where the risks actually are. Here's a deal property snapshot. Let's start with the basics. The property type is an industrial warehouse. The size is 6,000 square feet, and the location is in the city of San Bernardino, California. The asking price is $1,185,000. The current gross income is $97,200. On the surface, this might sound like a solid deal. So let's dive in, take a look at the numbers together. Hey, what's going on? How you doing? This is Robert Mendieta. I was just touching base with you right quick in regards to this. I wanted to just show this to you right quick. This is my deal analyzer, and you had a question in regards to values and whatnot. We look at several different metrics from cap rate, also the cash on cash return. We look at debt service coverage ratio. We make some assumptions, what you might be, how much of a loan you might be placing on the property. We look at the internal rate of return, which is actually the most important component. It actually is more important than even a cap rate because cap rates are based on 1 year assessments. This is based on your entire length of time that you intend on holding the property. We look at net present value, equity multiples, a break-even ratio, and loan amortization. So what I did is I actually went in and I started computing this out. So this is 1,185,000, which is basically the asking price. Gross scheduled income based annually. There's three spaces, and they're getting $2,700 a piece each month. So the total on that comes out to annually $97,200. I always put a vacancy factor in there, even though there's 3 units that are being occupied. There is one tenant that does move out. You have the ability to in and take a look at if you have to get a new tenant in there. Base the taxes on test of value. So in this case, I'm just using the purchase price. It's a 1,185,000, and the property taxes come out to 1.25%. This is just an estimate. It could be a little more, it could be a little less, but kind of a standard. We've an estimate of $4,500 a month for insurance, and then we can plug in a couple of other fees. Landlord says that he for the water, but he's actually reimbursed. So out of pocket, he only comes out to about $100 a month for water for him. But all the other expenses, as far as maintenance, I'm sorry, the any that accrued, there's other utilities that, so he's not being charged that. That they're being charged that. I look at some assumptions. A holding period of 5 years, an annual growth rate of 2%, and an exit cap rate at 6.5%. And then I put these metrics on the side over here. Your investment targets is 6.5 on a cap rate. Target cash on return is 7%. Internal rate of return is 12%, which the industry standard is pretty much 10%. And then a debt service coverage ratio of 1.25 with a discounted NPV of 8%. Okay, so go to the next page. It tells us that as it is a no-go, this is based on the asking price. It's $1,185,000. It actually has a $71,000, $71,828 operating income. So that equates to a 6.06 cap rate. And your cash on cash return is 2.27%. Debt service coverage ratio is 1.15. So the cap rate, you can see here, they're saying use caution. It's within what your, this 0.5% metric that I put in there. Debt service ratio, most lenders are going to want 1.25. I actually have a lender that'll do a 1.1. So, but the lower the DSCR percentage, the higher the risk. So that means the rate is going to be a little higher on that end. But the cash on cash, 2.27. So that's just that's just a fail. When we looked at that, the cash on cash minimum expectation was 7%. So that's definitely way off. Okay. But break even at 89%. Okay. And then internal rate of return that comes out to 7. Which is, way on target of 12. Right. And then the equity multiple, the target 1.5, we're at 1.3. Okay. Then look at this and how does this offer, where do we need to be at in order to make this deal work? So, based assessment here, in order to make this deal work, we need to be at $930,000. Okay. Now, if you're owner user, meaning you're going to occupy the property for your own purposes, you might want to pay a little more than that, right? But this is based on an pro forma. But your max rate floor, which is at 6.5%, this means that even if you're just a simple 6.5% target, your purchase price be 1.105 and still hit that cap rate metric. Okay. If we're looking at the floor on the DSCR, in order to hit the 1.25, which is right here, the 1.25 target for the DSCR, debt service coverage ratio, then we'd be at 1,091,000. So that would hit that target. Okay. So the property itself does, line certainly in its asking, but does line up in, like, let's say if you wanted to hit all those metrics, we need to be at 930,000. But if you're okay with just a 6.5% cap rate, that's 1.1. And then same with the debt service coverage ratio, basically 1.1, right? So anyway, hopefully that answers. If you have any questions, feel free to reach out. 951. My name is Robert Mendieta. 951-977-3251, and we'll talk soon. Thanks. If you're looking for an industrial deal and want a second set of eyes on your numbers, I work directly with investors to help them analyze, structure, and acquire industrial assets without leaving money on the table. Click the link below or reach out to me directly and I'll help you break down your next deal. I look forward to personally meeting with you soon.